Good morning, good afternoon, good day, whatever part of the country you're in, whatever time zone you're in. We'd like to thank you all for making time to come to this presentation. Do you have the right financial plan for 2021? My name is Maureen McBride, and I'm a co-founder and owner here at the Capital Masters, and we've got two brilliant panelists coming up. Mr. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. And over the course of his career, Bob has analyzed and contributed to the closing of approximately 400 million in business loans. And Rich Russakoff is the acclaimed author of Make Banks Compete to Lend You Money, the definitive guide to creating a dynamic narrative and top-notch business plans that give banks what they need to say yes to you. Together, our OG masters, and they truly are, they've been through more than one up and down cycle. These guys are going to share what you need to know and do before you go to a bank for your funding. In a moment, I'm going to turn the presentation over to the experts, but first, I'm going to highlight a few items that are extremely important to you. We're going to have two polls during this. Put your poll answers in so we can see how we're doing with you and work on that. And today's webinar is being recorded and will be available on demand after the live session. And second, we use Otter Live Notes, and you can either click on the red live icon on the top left of your screen and then click on view, and the notes will appear in your browser. And then we'll also paste the link to Otter Live Notes in the chat window. And once the webinar is over, we'll email you a link so you can access the recording. And please participate. We'd love it if you could put your questions in the Q&A tab. That's where we're going to look for your questions, in the Q&A tab at the bottom of your viewing window. And then we'll save your questions for the final part of the webinar. And we will be sending you a short survey link. And we know you entrepreneurs are overachievers, and we'd love if you could overachieve in filling out our survey questions. So let's get this party started. Expert time. Bob and Rich Russakoff, would you like to take over?
Sure. So let's, this is what the program is about, and we want to show you what you need to do to make a strong case for capital today. And let's move on to the next slide, and we'll talk more about that. What we're finding is that banks are not just looking at taking a narrow view of whether to say yes or no for a loan, or whether to continue the relationship you have. And Bob, what are you seeing that's so different than this time a year ago before the pandemic really hit the country?
Thanks, Rich. That's a great question. I mean, what I'm seeing, and this is actually real life experience with our clients and with conversations with bankers all over the U.S. that I'm having. And the reality is the scrutiny is 10 times what it used to be in the past. The credit officers are really running the show, when in the past it was the sales officers who were running the show. And then the credit officers would make sure that everything that they brought in was within policy, if it's SBA, within the operating procedure, or if it's conventional, within the bank credit world. So they're really looking hard at the industries, their performance. They know COVID's affecting everybody. That's kind of irrelevant at this point. They're looking for anything that they can use to say no. And one major thing I've noticed is on the front end, and I was one of these guys at one time, I could give a term sheet out if I felt, after I did a back of the envelope analysis, the numbers, the cash flow, the liquidity of the borrower, we'll get to what we call the four horsemen later. If everything was in sync, I would hand out a term sheet, get the deal into underwriting. Now, that's being scrutinized by not only the senior sales guys, but the credit officers too, to where
one case, Bob,
yeah,
we found in one case, after it appeared that everybody had approved the loan, in two cases we were looking for, upper management said no. So you just don't know where you stand. And let's get to the next slide. We'll talk about that a little more. It's really important for you to have contact with your loan officer and your bank to make sure that they're still players and are looking to loan you money. So I'd like us to ask you this question. Do you know if your bank is working with you to provide capital and maintaining your current loan? And it could be yes or no, and perhaps you don't know yet. But we'd like you to take a little time, a minute, and just give us an answer to this question.
we play the Jeopardy music, but we don't have it on hand.
We really should be having you play guitar, Bob.
Do, 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 do,
Do, do, do, do, do, do, do. That was the metal version. Do, do, do. Do, do.
We're almost there.
All right, we're here waiting.
Answer this poll. We want to move on. Looking good.
So what we're seeing is almost like how the Senate votes these days, 54, 46. The good news is that for 54% of you, your banks are working with you, and for the other 46%, they're not. And it's really, what we want to emphasize here is you need to know where you stand with your bank. So suddenly they don't look at your portfolios and say, we'd like to work on an exit strategy. We no longer want the loan. Do you want to comment on that, Bob, before we move on to the next slide?
Yeah, being that along with the CARES Act, which is supposed to give a lot of incentives, they're just not using them for the people that need them. It's more like a 70-30 split. So maybe that 54% is, are at banks that are favorable to the CARES Act. But at the end of the day, the auditors will be coming in and evaluating portfolios of these banks. So the credit officers are charging the sales guys or gals both to scrutinize their portfolios and start looking for possible scenarios where a loan or relationship might be going south, and try to head that off at the pass and maybe regrade it, downgrade it, or come up with an exit strategy. So they're looking at everything. They're running scared right now when in fact, if they had a more positive tinge on it, it might be more beneficial for everybody.
Let's go to the next slide, and I want to make a comment on that as well. Many of you have not submitted the 2020 financials yet. And when you do, that's when your bank may take a good hard look of how you were impacted by the pandemic or how your industry was. And that's when you might learn that while you thought everything was rosy, the game has changed. Let's take a look at the risk assessment that banks are doing right now on all their loans and how this might impact you. Bob, do you want to go through the risk assessment bullets here?
Yeah, banks, this isn't new, but the intensity of it is. Banks have always performed risk assessments. When I was a credit analyst with Chemical Bank New York, I had to physically grade every loan that came across my desk for industry, guarantor, financial performance, balance sheet, operational performance. We actually had a booklet that guided us mathematically to actually grade a deal. That's still going on. But what they're doing, instead of doing a 6-month review or a 12, they might be doing quarterly reviews to see where that relationship stands. So it's incumbent to know where you stand financially with your bank. When I was VP of Finance for Schlotsky's, which was the $450 million NASDAQ company, I was also the treasury guy. I was responsible for looking at our loan covenants and seeing where we stood from a cash flow basis, sometimes on a daily basis. So I would be responsible for seeing what our picture looked like before we went to the bank or before the bank called us. And you need to be doing the same thing.
So that leads to the bank not just looking at the performance of your loan to make a decision, but all the other ways you buy bank services, and what do they see from their perspective as the profitability they're going to make on your relationship, not just the loan. And Bob, do you want to share how that balance works? Because I think most entrepreneurs think, hey, it's about my loan, that's all.
Yeah, the thing that I hear the most is, well, we ran $1 million in deposits through the bank. Why won't they give me what I want? Well, that's really not where they make their profit. Part of the analysis that I would do, in addition to grading a loan and looking at all the standard credit issues, was, is this deal going to achieve a return of investment or return on assets of at least 20% for the bank? I mean, that was the metric we used at the time with Texas Commerce Bank, Chemical New York, Chase, it all merged. So they're looking at the full relationship of non-interest income in addition to interest income from loans. And of course, deposits allow them to make more loans. That's a good thing. But just because you're running deposits through a bank doesn't mean that you're profitable. You're probably not. So they have something called compensating balances that they use through the treasury management departments to determine really how much money they're making on you.
Okay. So what are some of the areas where we might not even be aware of, but banks are analyzing in terms of determining the risk assessment and the overall profitability of the portfolio?
Well, risk assessment is all dealing with the loans. So that's going to be everything that is incumbent within the loan agreement for that deal, and cash flow coverage ratios. If they have liquidity requirements, looking at current and quick ratios on a deal. Maybe they have fixed charge coverage ratios that encompass capital expenditures, rent, and things like that, which the analysts would develop on their own. So it'd be unique to that business. It could be, what is the profitability on other services, treasury management.
That's what I'm talking about, Bob.
Okay, well, yeah, you had mentioned credit, so yeah.
What are some of the other areas where banks are making profits theoretically, and I need to know about in order to make sure that the bank knows services I'm using, or so I know what's valuable?
Credit cards, trust, treasury management, insurance services, armored car, if you're a coin intensive business, that could be with parking meters, whatever like that. I mean, there's quite a few insurance services, wealth management services, stock purchases. There's actually quite a bit.
Okay, so is there any way I can find out by looking at my monthly bank statement, other charges?
Yeah, you can find other charges. I'm going to cut you off because you can find other charges, but you're not going to see your profitability, not unless if you're in a treasury management capacity with the bank. They might be sharing the compensating balances and telling you that your services have all been paid for, which in that case you are profitable, but you will never see those numbers.
Okay, let's go on to the next slide. And Bob, before I ask you for definitions to the four horsemen, I wanted to share, when I wrote my book on bank financing, and with the loans that I've been able to acquire before Bob and I worked together, I never looked at these four assessments of credit. What I did was try to present a narrative and a presentation that the loan officer liked. They knew how to sell it, and they thought that uh, that it would be approved. But Bob, when you do your assessment of a company, you're looking at all four of the uh, four horsemen of credit. Could you just talk a little bit about each one of them and its importance?
Yeah, because basically a story doesn't repay debt. So what happens is when they would get Rich's portfolio and they liked it, they would send it in. Then the credit officer would have to get everything that I'm referring to here on the back end and then back into it, which is neither good nor bad. It's just the way it went. This is my term, the four horsemen of credit. It's not, you're not going to find it on Wikipedia or anything like that. Basically, the first one is liquidity, and that's going to be how much cash on hand does the business and the guarantor, the person borrowing the money on behalf of the business, have in the bank. And liquidity is deemed as instruments that are convertible to liquid to cash within 90 days or less. So CDs, savings accounts, business accounts, cash accounts, money market accounts, things like that. So liquidity is going to be how much cash do you have? So the other thing is that dovetails with that is equity, and equity doesn't have anything to do in this context with your house. Equity has to do with, do you have sufficient liquid cash in order to make the required down payment for the type of loan you're asking for? And these aren't boxes that are checked. This is actual analysis that is performed based on financial statements and banking statements, brokerage statements, and things like that. So the bank's going to want to determine not only that you have sufficient money to make a down payment, but you have sufficient reserves that you're not relying on bank debt for example, for personal expenses and things like that. Collateral is hard security for a loan. Real estate, maybe seconds on single family residences, raw land, investment property, office buildings, anything that's brick and mortar, or as I stated, raw land that the bank can attach a lien to and use it in the event of default on a loan and either foreclose on it, sell it off, or have the guarantor liquidate it to repay the debt.
Bob, before you go on, I just wanted to point out that why this is so important to the bank is they want to know if your loan goes south, how they're going to be able to make whole on the loan. And liquidity, equity, collateral are key components of that. And then we get into the sticky area of who's guaranteeing the loan. And Bob, do you want to talk about assumptions you see entrepreneurs make and what's the reality there in terms of a guarantee?
Yeah, the biggest assumption I see is what I call the ego assumption. Well, heck, I don't need to guarantee this. I've heard where they're making, they being banks are making non-recourse loans all over the place. Bob, I want you to negotiate a non-recourse loan for me. And I'm going, this is only $1 million or $500,000 deal. And you're telling me you're not going to back your own loan? Why should the bank back you? Non-recourse loans are for 5, 10, 15, $20 million deals where it's a whole different underwriting set, and you're dealing with REITs and institutional lenders that operate totally different than banks and lending institutions do. So the bottom line is be prepared to guarantee the loan, and not in a limited basis, but in a full 100% basis.
And the reason that's important is because this is the key factor when all else is said and done. that the bank will be able to say, yes, I want to do this loan. The liquidity is there, the equity is there, the guarantee works in order for us to have what we need to go after uh, capital to repay this loan if you default.
Yeah, basically, what we were taught in the Risk Management Association credit analysis course at Chemical Bank, New York, was you need three sources of repayment to document for your loan presentation as a credit analyst. The first one was, of course, cash flow from operations, repaying debt. If that failed, foreclosure on collateral. If that failed, you sue the guarantor and you get your money that way. So those were the three sources of repayment. So that's why this is so important. And over the past couple of years, pre-COVID, you might get away with doing two of those, where it's cash flow from operations and collateral. Nowadays, most banks are wanting all three.
So the issue with the guarantee, we went through this with a client where they were asked to pledge hard cash because they had nothing else to pledge in terms of collateral, which could be turned into liquidity. And they said, hey, that doesn't make sense. If SBA is guaranteeing 90% of the loan, why do I have to guarantee anything more than the 10%?
Yeah, and there was one fallacy in that, because they thought in their mind that guarantee meant collateral. Though that's just not the case. Guarantee has nothing to do with collateral.
So specifically, Bob, in a sentence, what does that mean? You're the guarantor on the loan.
I mean, first of all, a 90% guarantee from the SBA, yes, the bank ought to be taking that and running and utilizing the CARES Act to its full extent, but they're not doing that, except with about maybe 30% of the borrowers that are going in. A 90% guarantee to the banks doesn't dictate that if this loan goes bad, they're going to be stuck. I mean, the SBA is going to repay them. They don't know when that might happen. So they're really going overboard and trying to get the loan secured more than it actually already is. And yeah, go ahead.
That's also changed in 2008, where SBA need for guarantors and need to know that there's liquidity to the deal are essential, or the bank won't even submit it to SBA.
Well, and today you don't submit to the SBA. Most 90% or more of all banks are what are called PLP lenders, preferred lender program. They decision on behalf of the SBA. Rare occasions does a bank actually send a deal to the SBA for approval, and that would be called GP. And that some banks are utilizing that, where they're so scared of what's going on, they don't want to make the decision. So they put the onus on the SBA. That way, if it goes bad, the SBA eats it and they don't. Because mind you, even though the guarantee is there, if the SBA has to collect on the guarantee and pay the bank's going to get a big black mark, and they're going to be under increased scrutiny during audits.
So it's not I could care less, SBA is going to pay for it if I'm the bank, and there's no recourse on me.
Doesn't work. Yeah, it doesn't work like that. No.
Let's move on to the next slide, because the next two slides are going to tell you what's critically important for you to have in your package, or for you to be aware of, that the bank is going to consider. Why you need the financing is not just to say working capital, or I need a line of credit. What we do, and this has come from my working with Bob, is we say, for example, we need $300,000, and we tell them almost to the penny where that money is going to go in our narrative. Bob, do you want to go deeper on that one?
Yeah, I mean, it's called a uses of funds. You have the source of funds, which is the loan, and then how it's going to be used. And for small business loans and even conventional loans, the bank needs to know what buckets are going to be utilized for their disbursement of cash. And buckets can be for marketing expenses, can be for purchase of new tech. It could be for capital expenditures. So those buckets need to be delineated and outlined in a spreadsheet as to what they are, why they're needed, and how much they are. And that makes it a heck of a lot easier for the bank to work out, the sensitivity analysis they're going to perform. Plus, each of those items has a weighted average time similar to depreciation, but I'm just using that as a word, where they can determine what the actual length of the loan should be based on those items.
And we're working with somebody right now that's going to need a lot of legal advice because they're introducing a new product on the marketplace. They want to be able to cover themselves so others can't rip it off. So expenses like that, part of research and development, also should be included if that's what you're going to need to use the money for. Bob, the next one is your favorite in terms of what everything else has to do to answer this question.
And I think I did that on the previous slide. Cash flow from operations, foreclosure of collateral, and suing the guarantor. Those are the three. That's how the loan will be repaid. But as an entrepreneur, you need to state that in your narrative of how you intend to repay the debt, which also dovetails into your projections and your assumptions. Numbers are meaningless without the rationale for how those numbers came to be.
Yeah, and that's a critical point. Everything you put in by way of a projection or by way of what's going to happen, you need to be able to have a page of assumptions that back up the credibility of the statement. Now, Bob, I did better this year than I did last year during the pandemic. Shouldn't that speak for itself? Why does the bank look at every single client right now in terms of the impact of the pandemic?
Well, I mean, that statement doesn't really tell me anything. I did better last year than I did this year. Okay, so what? What was your cash flow? What do you have in reserves? How are you doing as a guarantor? Has your situation changed? What's the risk in your industry? So that statement is really meaningless to a bank other than, hey, we did better than we did last year. Well, good. Okay, so I don't care. Show me some numbers. Show me some proof. Let's substantiate it. How did you do better? Are your sales on an upward trend? If you're a franchise, are your same store sales better than last year? What's your compound annual growth rate look like? I'm going to throw a million questions at you. So, be prepared.
And that gets back to the point that banks look at what you've done historically much more than what you say you're going to do in the future.
Yeah, venture capital guy, which Rich has talked about before, might be looking ahead and forward into the future, but the banks, they're looking at historical performance.
Right. So let's go to the next slide because I think we touched upon one or two of the points on this. In virtually every package that I've done and that you've done, Bob, with me, we're talking about the competition. And every now and then I'll have a client say, well, I don't have any competition. We're unique. Why does that argument fall flat with a bank, Bob?
Yeah, because, maybe you're in microproton development with molecules from the planet Venus, you might not have any competition, but the bank's going to call BS on you because they know your industry based on your NAISC code, and they've probably done many loans in that industry already. They're going to know you have competition. I hear that even for restaurants, which is ludicrous, and franchises, that now we don't have any competition. I pull up a Google map, I find 30 restaurants and bars within a 1 mile radius of them. Go, yeah, you do. Do you know anything about these guys? You know their sales, their table turns? I mean, you're going to get eaten alive. You do have competition unless you're so unique.
So what we do when we do a package is we share with it, we identify who the clients are, the competition might be, and we write in the package who they are, what they do, and why we believe we have a unique competitive advantage over the competition. And that's a critical piece if you're putting together any package, be it a verbal or a written presentation. So that leads to the next piece, which is your financial and operational performance. I'm working with a client right now, and they thought they were ready to go to the bank, and they looked at their 2021 January P&L, and I said, this can't make sense. You're looking at $125,000 in working capital. It was documented wrong. It did not document working capital by unit. It did not document by unit the cost of bringing containers over from overseas. So what are you telling the clients that we're working with, Bob, as to what they need to do to be able to explain their financial situation and their operational performance? And let's talk a little bit about operational performance.
I mean, financial and operational performance relate to your balance sheet and P&L. They're accounting terms and finance terms. Do you understand your balance sheet? Can you vocalize, alliterate, whatever, you know, the components of your current assets, your long-term liabilities, your equity position, retained earnings, can you discuss your P&L, your profit and loss statement, your major expenses, how you're using depreciation, cash on hand in banks, on the balance sheet? I mean, do you have staff on hand that can discuss that with the bank and use basic accounting and finance to be able to make an interpretation and understand where you're at?
Bob, one of the things you talked about was the balance sheet. And I will bet you a third of the entrepreneurs do not know how to properly read a balance sheet and or read it and see where it's not accurately reflecting your current balance information. For example, there's a difference between short-term and long-term liability. The short-term liability, that is weighed against your assets. So if you've got a loan with another bank that's going to be paid off over 5 years, the only thing that should be on your short-term balance sheet, short-term, is what are you going to pay in the next 12 months? And that goes to any other loan you might have, because that's the critical piece in that ratio. And then everything else would go into long-term, and that's a different relationship of where you stand altogether. Anything you want to add to that, Bob, or maybe make it clearer?
Yeah, that's called current portion of long-term debt, CPLTD. And that's used for a lot of calculations by the bank. Bankers are going to be looking at any loans you have on the liability section that might be to shareholders, and they're going to take those loans and they're going to move them to the bottom of the balance sheet. They're going to throw them in the equity section because they believe that in the event of a default or a failure of the business, that the owners and whoever they made those loans to are going to be paid before the bank does. So when they analyze you, they're going to rearrange your balance sheet to where it benefits them. So one thing I might add is entrepreneurs, unless you're a CPA or an accountant, you don't need to be doing the general ledgers, general journals, and doing your own balance sheets and cash flow statements. You need to have a qualified CPA or bookkeeper or financial analyst do that for you. It's going to cause issues.
So, Bob, one of the things we do is we do an industry analysis on a company, on their industry or their piece of the industry. And it's something that if people decide to work with us on putting together a bank financing package, we will gather that information. And that gets to, do you know your industry matrix? Where do you stand? And Bob, why is that so crucial?
Well, I mean, especially in COVID, how is your industry performing overall? Is it up or is it down? If you're doing pizza, you're up probably 15, 20% over last year. If you're in oil and gas or audiovisual, you might be down 40, 50%. So one thing is, you need to really understand where your industry is, and that's going to affect your projections and how you're going to be approaching the bank and making your strategic decisions. And within that, your industry is going to have specific metrics based on asset size, sales size of your company for things like current ratios, quick ratios, receivable turns, things that the banker is going to look at, the credit analyst will look at, and determine how you fit in the mix with everybody else in your industry.
And for example, if you're a restaurant, they want to know how many tables you have, how many tables do you turn, what's your average check for lunch, what's your average check for dinner, how much revenue are you getting from alcohol, how much revenue are you getting from pickup and delivery during this time of COVID. And if you can weigh that against what the industry is doing and you come up favorably or above, you have a much higher chance of getting success.
Plus, it tells the bank individual that you know what's going on, that you're astute enough, that you're the way you run your company is telling them that not only do you understand industry and competition, but you're incorporating that into your thought process. So that's huge.
So let's go to the next slide and talk about what we mean by agility, particularly in today's marketplace. And I'm just going to start it off by saying you can't control the wind if you're at sea, but you can adjust your sails. So we're saying this is a sign of strength. Let's talk about why, Bob. What do you see if you're the credit analyst in terms of how the company has responded to the pandemic, for example?
Well, that's one question that's going to be asked is, what are you doing to pivot within this crisis? They want to know, are you crouching in a fetal position? Are you like the emu and putting your head in the sand? Or are you out there fighting the wind, adjusting your course and trying to keep your boat on tack? So they're going to want to know how you're performing and what you're doing in this environment.
Yes, and that means being able to show them this is revenue we received in 2020 that was not even a profit center in 2019. And this is how we made the adjustment, and this is the impact it has. When we're talking about agility, Bob, are we talking about anything other than just pivoting?
Well, I mean, it's pivoting and flexibility. Have you had to uh, lay off staff? Have you reduced the CEO reduced their 400,000 a year down to 250 to increase cash flow within the company? I mean, what all have you done? So it's not just pivoting; it's other operational aspects that you've done strategically to help the company go forward. And if you have laid off companies, have used PPP or idle loans to bring, not companies but people, have used PPP or idle loans to bring those people back.
Thank you. Let's go to the next slide and why this is important. We put together a group of people that might be better suited as a business to go for investment capital than the bank because they look like they're young, they look like they're a startup, and the bank is going to look at you fresh right now as if you were a startup. Um, and that's why it's critical for you to be able to make the best case. So what does that mean? I've been with you for 10 years, Bob. Why are you looking at me like I'm a startup now?
Because we have failures in our portfolio. COVID's decimated us. We have, 50% of the bank's portfolio is in some sort of distress. We don't want to lose our capital base and be out of business. So we're going to scrutinize every account we have to make sure that it's either on par, or if it is going down, is there something we can do to help, or do we need to develop an exit strategy? And this guy on the left with the hair and the coat and the t-shirt, I don't want him in the meeting.
All right, so appearance is important here. Why not, Bob? He's a good looking dude.
Yeah, I think he's going to kill the deal. He doesn't look right. He reminds me of a cartoon character from the 80s.
So that all goes back to presentation, and not just presentation in the form of a book, but ultimately we get back to the fact that the bank is lending to you and to your team. So they want to make sure that your players are all professional and that uh, because I'm making the loan to you, do I, when I look at you, see somebody credible that I'm comfortable making that loan with?
Yeah, I mean, the banks are going to look at the presentation itself. They're going to look at the narrative. They're going to look at the documentation. They're going to look at you. They're going to look at body language. I mean, when I was a credit officer and loan officer, we had classes on body language of clients and what to look for. I mean, you need to put your best foot forward, and especially now.
So let's go on to the next slide. And Bob, do you want to explain this picture and the dynamics of what a credit manager is going through and the importance of giving them everything on round one?
Yeah, and this is not a credit manager. This is a credit analyst.
Yeah.
Credit manager is not going to have an office like that. This is the guy or gal who is actually doing the work. And when I was in that position at Texas Commerce Bank, when we merged with Chemical New York, I'd have 12 or 15 loans on my desk at any given time. And that's probably a pretty correct looking picture of what this gentleman is going through right now. If you want to layer PPP on top of that, they're not just doing one file and just looking at yours, and they're looking at a bunch of stuff, and they're all different industries, all different deals, and you can pull your hair out. So that's a pretty accurate picture of what we're looking at now.
So that gets back to the whole point that right now you've got to think credit analysis over the banker that you meet that is your loan officer, because they have lost their clout, and you must be able to satisfy the credit department if you're going to move forward. Now, you always had to do that, but now more than ever, that's who you should be making your presentation uh, to, in terms of what you write, what you give them, and the many things we talked about today that are critically important. Let's go to the next slide. So we're curious to know how many of you have funded your business through PPP and EIDL during the crisis? And we're going to give you guys a minute to answer that question, and then we're going to talk about why that's important.
And then moderators, how are we doing on time? Are we going to have enough time for people to ask questions?
Bob, I think we're going to be good on that. Well, I'm sure if you haven't gotten an EIDL loan, there's probably a good reason why you didn't apply for it. But in the past, not today, uh, EIDL loan, getting 150,000 for a business doing above $1 million was probably easy to do. I'm surprised that not more of the businesses on this call have gone for PPP or EIDL because it's very important. And let's take a look right now when PPP is still in play, why time is of the essence and why you may have missed the train. Bob, please answer that.
Yeah, the banks I'm working with, most of them have already stopped within probably 2 weeks ago taking any applications for PPP. They're filled up. They can't, they're at their saturation point. With their existing workload coupled with PPP, they can't handle any more volume. So we're down to probably tertiary and quaternary level lenders and businesses that are providing PPP. I know that Cabbage was shut down, for example. They were shut down early. And there are many banks who, if you didn't do your round one with them, they were not going to look at a round two for you. So in my mind, it's getting later and later to where the probability of getting something done is probably pretty low right now. But there are a few banks that are still processing.
So Cabbage, if I've got this right, Bob, is a fintech lender. And when you say they were shut down, what do you mean? What happened?
They're out of capacity.
Okay.
They can't take it. They had to shut the doors. They couldn't take any more deals.
Oh, and they couldn't because they didn't have the infrastructure, or would there be another factor?
Well, I mean, that's really the only factor.
Okay.
You run out of staff. You can't take any more deals.
Okay.
It's like Franklin's barbecue. Once you're out of brisket, you got to close the doors.
It breaks my heart. I've had that happen once at Franklin's barbecue, which, by the way, in Austin, Texas, and the best barbecue in the country. And when Mo and I got married, we had Franklin's as one of the one of the food sources that catered our wedding party. But that's another story. Now, if you heard Joe Biden on TV the other night, he talked about $65 billion that will be available again to entrepreneurs and small businesses to get them back on their feet. Now, 65 billion sounds like a lot of money, but there are a whole lot of entrepreneurs out there. And we know companies in the beginning of EIDL, when they were giving loans of up to 2 million, were able to get 2 million. Then they changed it to only 150. And most companies that went for an EIDL loan then got 150 or less. Bob, I'm the optimist. I think there's going to be legislation, and there must be, to open small businesses again. But there are also other programs that are available on a state level, or may be available because of minority status or a woman-owned business. What's out there now that you're aware of that can help me? And what do you see coming by way of EIDL opening up again?
Yeah, as far as what's out there, there's 50 states. So that's at the minimum, probably 50 programs. I have no idea. What I would suggest is to go to the Department of Commerce or the state agricultural or USDA or other types of websites, and kind of peruse the loans and grants that are out there that are separate from the CARES Act and such. And PPP, by the way, is embedded within the CARES Act, so it's one and the same. As far as the 65 billion, I'm a banker. I don't believe it till I see it. There's too much weird stuff still hung over in DC, and if that gets passed, that would be a really good thing, and we'll see if it happens.
So what I'm hearing you say is, do your homework if you're looking for capital. Not just assume that a banker will give you the capital you need. There are other programs. Find out what's available in your state and be prepared for EIDL or PPP to have a third round. Let's go to the next slide. And that's questions and answers from you guys. So I'm going to turn it back to Maureen. And what questions do you have?
Well, I'm looking for questions. If you have failed to put your question in, please share one with us now. I did have one. I invested in a very large piece of equipment to run my business, and it looks like I didn't make any money in 2018. How do you address something like that?
Do you mean
it looks like I didn't make money in 2018 after I bought a big piece of machinery?
Right.
I don't understand the question, because
Rich, the way I'm guessing that the way their accountant did it, they took the.
Oh, they wrote off the machine.
Yes.
Yeah, if they did that was a bad accountant. He doesn't get a treat, or she.
Okay.
Yeah.
Let me tell you how I would deal with that. I would recast my P&L and say that was a one-time expense, and we decided to take it that way. But this is a discretionary decision we made, and we should move it below the bottom line. So we're showing a profit for 2018 with an explanation of how that impacted us and what we chose to do for tax purposes.
Yeah, and what I would say to that is, if it's a large piece of machinery, why didn't you use the modified depreciation method or standard depreciation for that asset, which could have been 10, 15, 20, or 30 years, depending on what it is, take advantage of the depreciation. And it's not listed as a, $500,000 expense item on your P&L, and you can add back the depreciation as a non-cash item, and that helps your cash flow for the bank.
Exactly.
That's accounting 101.
So if you
one mistake that entrepreneurs make is they're so hell bent on trying to not pay tax that they're showing losses. And when you have, for example, SBA loans that rely on government statements, meaning your tax returns, there's no way you can reverse that. They have to go by that. And if you're showing losses, you don't get a loan.
Well, one thing I've been able to do with clients is the equivalent of an EBITDA, where I say, these were our actual expenses for the year. This is a one-time expense. This is discretionary expenses that the business is paying for, like my car or my boat. And I move them below the bottom line. And I say, this is the equivalent to how the owners chose to spend their cash. And that has worked for me. But you really have to make sure it's clear and it's valid, and they will consider that.
Yeah, today I don't think that would work, but that's similar to what they do in the business acquisition world. But in the credit officer is going to know exactly what's going on there.
So I would say you have nothing to lose by trying it, if that's the
Sure.
case. And different banks will respond differently to it. Do we have any other questions, Mo?
Not at this time.
Okay. So is there any, so that covers it for questions?
Yes, if anyone has a more personal question that they'd like to share with us, you can contact us through social at thecapitalmasters.com, and we'd be happy to do a one-on-one call with you specifically about your business.
Okay, there is one thing I want to share in case you're wondering how we might be able to help you, and not necessarily with a full-scale loan package where we do the writing and find the banks for you. But we've got a program that I think may be valuable for you to consider, and we're going to kick it off in March. And we're looking for a group of entrepreneurs that are looking to put together the right package, and we'll help walk you through that. So what you will get if you are interested in our program is you're going to get a Bob's help and guidance as your bank financing coach to make sure you've dotted your I's and crossed your T's. I'll be looking at the strategic plan you have for your business and how you might tweak it so that it gives you more clout when you speak to the bank. And we can also help you write the package. We have 2 writers on our staff who know how to put together a package that will get to yes. I believe there's at least one more slide, and this is a huge bonus. We'll get you the industry report for your business that you can use for your marketing and that you can use as part of your package. And this alone is worth $3,500, and it'll be part of what you receive. Before we jump on to the next slide, Bob, let's talk about why that's important, that industry information that we are able to obtain for clients through a relationship we have with IBIS.
Well, one reason is the banks all use this. And the other major reason is it'll give you a comprehensive view of your industry at all levels and give you valuable industry metrics of all of the financial ratios, sales ratios, and everything else that you need to make strategic planning decisions with.
Thank you, Bob. So we would like to thank everybody that was on the program and stayed with us. We hope we provided you with the information that will help you make the best decisions. As Maureen pointed out, if you want to schedule a half-hour call with us to discuss where you are, there's no obligation. We'd like to help you all grow. And with that, I'm going to turn it back to Maureen. Thank you, Bob, and let you wrap us up today, Bob.
I think if anyone's curious about the Entrepreneurs Intensive program, it is specifically designed for entrepreneurs, and you can think of it as a 4-week mastermind. And you'll walk away from that program with the elements that you would need to apply for a bank loan that's more likely to be approved, because Bob and Rich will be working with you during that mastermind. It's on our website, capitalmasters.com. And if you just look for the Entrepreneurs Intensive Program, there's more explanation about that on the website. So thanks again for joining us, and good luck in 2021.